Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm excited to be joined by a repeat guest today, Will Matheson. Will, welcome back to the show.
Thank you for having me.
Yeah, well, Will, the reason why you're back is you're closing deals in this environment, and we want to know how you're doing it. Okay, so today we are going to talk about Residences of St. George, 248 units in Savannah, Georgia. So give us, I know you know, for listeners who haven't listened to the previous episodes, tell us a little bit about yourself, where you're at in the multifamily space, and what you're doing today.
So my company, Matheson Capital, we are a real estate investment firm. Obviously, that's why we're here, based in Charleston, South Carolina, and we buy assets in North Carolina, South Carolina, and Georgia. The reason we're able to buy deals in this market, really, I'll be honest, a lot of it has to do with luck. We were very fortunate that we sold the majority of our portfolio at the end of 2021 and the beginning of 2022. So really kind of peak of the market timing for us. We sold a lot of our assets, so we didn't have any distress in our portfolio. And we have a lot of happy investors. We have a nice track record we've been able to build out. So because of that, we've been able to actively buy. We've led 3 acquisitions in 2022, 2 in 2023, and we just closed a property in May of 2024. Like I said, we're in a pretty good spot due to some fortuitous timing on our end.
Well, let's talk about Residences of St. George, 248 units, Savannah, Georgia. When did you close on this property, and what was the purchase price?
So we closed on May 10th, 2024, purchase price $38.8 million. So roughly 156 a unit.
Okay. So how did you find the deal, and when did you find the deal?
So we found the property, I want to say maybe it was October or November of 2023. We have a really great working relationship with the guys over at Berkadia. We've closed our last 3 acquisitions through Berkadia. And in this situation, we were buying, I believe the last time I was on your podcast, we were talking about Residences at Cooper Bend, a 76-unit property in Hanahan, South Carolina. That was the same owner as Residences at St. George. So we had just finished purchasing that property. We knew this property would be available to purchase as well. So we were talking to the brokers, talking to the owners, said, hey, look, we'd love to buy this one too. Just had a successful closing together. Everyone's feeling great. Let's move on to the next one.
Awesome. Okay. So how did you guys get to the offer, and what was it being offered at?
So it was off market, not a marketed deal, but as I understand it, I believe it had just fallen out of contract with somebody else. I don't know the exact price on that, but we were essentially there to pick up the rebound, as they say, which has actually been the story of our last 3 acquisitions. I believe all of those came right after it fell out of contract with somebody else.
And why did it fall out of contract? Do you know that?
I don't directly know that. I mean, clearly an issue came up. I think, as I recall, maybe they didn't budget enough for exterior capex or something along those lines. So, you know how it is. You offer on a property, sometimes you see it and everything's just not quite how you like it. And maybe it was a stretch to begin with, but for whatever reason, they did the on-site due diligence and the former buyer wasn't quite happy with it, which redounded to our benefit.
Okay. Well, we'll get into due diligence here in a second, but how did you structure the offer in order to win the deal?
So, I mean, I would say there really wasn't anything too special about it because it was a loan assumption. The loan assumption, 2.95% fixed for the next 8+ years on the term. It didn't come due until I want to say December of 2032. So really the offer was just, hey, look, here's the price, earnest money, we'll go through the due diligence. And given that we were negotiating this contract in October, I believe we signed in early in November, we were actually very adamant about this contract needs to be done in business days. We're going to deal with Thanksgiving, New Year's, Christmas, Hanukkah. We've got to do this in business days because calendar days is just going to really ride the thing out. As you and many of your listeners probably know, loan assumptions are like beating your head into a wall. So we had to account for all the time it would take to go through Fannie Mae and all of these things, get underwritten, have any beneficial owners underwritten. So it was a long time. I mean, we went under contract in November and we didn't close until May.
Gotcha. All right. So in order to get to that, it was 38 million, right?
38.8.
38.8 million. Did you guys have to go through rounds of offers, or were you able to kind of get it, the purchase sale agreement signed, pretty immediately? And then like, what was the actual structure? I mean, you've got the loan assumption in here. We know there's kind of that wiggle room timeline with the loan assumption, but like how many days did you have for your due diligence?
Due diligence, I want to say, was 30 days. Maybe it was 45, but fairly typical 30-day due diligence. And then the loan assumption was written as something to the tune of maybe 70 or 75 business days, something along those lines, with 30 or 15 days to close after that. And maybe we had a or a buyer extension for 30 days.
Mm-hmm. All
These loan
right.
assumptions, I've done two of them now, and there's always something that just comes out and gets you on them.
They're special. All right,
Look,
and
for 2.95%, I'll go through the brain damage.
exactly. Yeah, no, I totally hear you on that. So how much earnest money did you have down and when did it go hard?
I think it was 1% on the earnest money, and it didn't go hard until a long way into the loan assumption process because, Fannie Mae rejects you for reasons unbeknownst to you. So I think it was non-refundable after 30 days unless we were rejected for the loan assumption. So yeah, 30-day due diligence, and then it's just a contingency on are we approved for the loan.
Got it. Okay, so semi-hard after 30 days, and then we still have to clear that last hurdle. So how did the physical due diligence on the property go? You mentioned that it had fallen out of contract, citing, issues with the physical due diligence before. How did it go for you?
We actually thought it was really the property looked fine. I mean, and I think that was in part because we knew why it had fallen out of contract the first time. So when we were putting our offer together, we were able to say, we're going to need, I don't know, this many hundreds of thousands of exterior due diligence and et cetera, et cetera. I believe in the end, we have north of $2 million of CapEx set aside for interior units plus exterior work on the project. We plan on making pretty significant investments to the asset. But, we toured the property. You find an issue here and there. There's 248 apartments. You're going to find something. But by and large, the deal was what we expected to be. And we didn't have any retrades or anything like that.
So what kind of exterior, deferred maintenance are we looking at here? Can you get kind of color a picture of why you have such a large CapEx budget set aside?
Well, some of the roofs, the property was built in two phases. About 40% of it was built in 86. The remaining 60% was built in 99. So the 86 side of it, it's a bit dated looking. The roofs are getting old, and it could use a little bit of a touch up on the outside. It happens to be the case that as you drive up to the property in the leasing office, you pass the older side first. And then you get to the leasing office. Behind the leasing office is the newer side. So I think it would be beneficial if we, touched up the 80s side, made it a little nicer, give it a little bit more curb appeal.
Got it. Yeah, you don't want people to be turned away before they get to the leasing office. So, okay, so physical due diligence, we know about the roofs and, just sprucing up everything on the outside. Were the interior units, up to par, or was there a lot of work that needs to be done there?
So we had roughly 50%, maybe 50 to 60% of the units had already been renovated at one point. We're not reinventing the wheel. This was a proven value add. We weren't starting from scratch. So 50 to 60% of the units are already renovated. And our goal was we're going to go in, we're going to do a slightly nicer renovation, but we're going to assume we get the same rent. We're going to do more, expect the same, which is how we generally like to underwrite these renovations. And I have to say, the 80s side of the property really held up well. You would think, maybe you're striating between your 80s side, your rents are lower, your 90s side. I actually really liked the 80s units. Some of them had these really cool built-in bookshelves, a place where you could put one of those old classic TVs that weighed 300 pounds with a giant box in the back. I remember having one of those growing up. But yeah, the units looked really phenomenal. on both the 80s and 90s side.
Awesome. Okay, let's talk about the financial due diligence. How did that turn out for the property?
Financial due diligence, we're in a very fortunate circumstance. One of the reasons, and this has to do with the market as well as the property, but as we were under contract on the property, we were getting new financials every week, every 2 weeks. Just here's the rent roll, here's collections, and we had a guy on our team, Alex, every single time he would update the model. New numbers, update the model. New numbers, update the model. And the property continued to improve its performance. Collections were going up, gross revenue was going up. So it was really, we were really fortunate in that respect. The owner was doing a great job. They didn't just let it slip away while it was under contract. So we really appreciated that. Thank you to them. Uh, but yeah, all the financials more or less checked out. There wasn't too much to say. We've bought from them before, so we kind of knew what to expect. And yeah, we were able to just move forward.
Awesome. Okay, so tell us a little bit more about the loan assumption. What were the terms on the loan assumption? Is it fully amortized? How much runway do you have on this loan? Yeah, just give us the details.
So I want to say the loan was originated, it must have been December 2020. I think it was a 12-year loan with 4 years interest only. So the interest only is going to end later this year. But it after the IO period ends, it's a 30-year amortization that's going to run until 2032. And we really like that, especially in today's market when some people are saying higher for longer. Some people think we're going to see rate cuts. Is it ever going to go back to zero? Who knows? Probably not. But people are bad at predicting the future, as I understand it. Predicting the past, much easier. Predicting the future, so much harder.
Hmm.
Um, but yeah, the way we looked at it was even when the loan starts amortizing, you're dealing with a loan constant of, I want to say 5.05, 5.1%, which is cheaper than getting new debt. So even if you were getting 6% interest only debt, you're still having a higher loan constant than you would just by assuming this existing loan. We layered a supplemental on top of it, let's say $3 million, give or take, just to kind of boost that LTV. And we ended up at around 67% LTC on the deal by the end of it, which in today's environment, it's hard to get a new loan at 6% that has 67% LTC. So to have the blended supplemental in the threes at 67%, we thought was phenomenal.
And so you're not doing that supplemental loan now. When are you gonna pursue that supplemental loan?
We took the supplemental loan at closing.
Oh, you did? Okay.
Yes.
I think that's very intriguing. How many operators out there are actually looking at not only assuming the loan, but taking a supplemental at closing?
I mean, I know there's the ability to, you buy the asset and you plan on doing the supplemental in 2 years. I was talking to a friend of mine just now saying we want to take on 7-year money so we can do the supplemental before year five. Being honest, our outlook on it was if we're trying to provide a 20% return to our investors, 20% IRR to investors, if I can fix $3 million at, call it 8% or 7 something percent, that's a net positive to all of the investors. So let's just take that off the table. It decreases the amount of equity we need to raise to get to closing. That's how we looked at it. It's cheaper to pay 8% on debt than it is to pay 20% on equity.
Mhm. And so between the assumption, when it starts, the principal period, the interest only period runs out, and then the combined loan assumption, you're in at what blended rate?
The blended
Not loan
rate, I want
assumption,
to say
sorry, supplemental loan.
the supplemental loan. So it's coterminous in pretty much every respect to the primary loan. So its amortization will start at the same time the
Mhm.
amortization on the primary loan takes place. So November, December of this year, we looked at it, or how should I say?
What's your blended
Blended
rate?
rate is mid to low threes.
Okay.
Yeah.
All right. So, thank you for going through that with us. Is there any prepayment penalty like with this project?
So I had to look into that when we did our Summers Run acquisition. One of our investors asked, "How does the prepayment on the loan work?" And typically you're going to find a lockout period, but I was using the resources over at Chatham Financial, using their website, and as I understood it, typically, because the rate is so low, if you were to go into their prepayment calculators and try to do that, it essentially costs you $100,000 because in these yield maintenance defeasance type things, it's like if you sell, you have to offset it by buying the corresponding treasury length. But given the interest rate is so low and the forward curve is never going to hit that low again, not that the forward curve's ever correct, it was essentially saying, yeah, you're not really in a prepayment situation here. You'll probably just have to pay $100,000 and that'll dissolve the loan because you could offset it with a higher yield on treasuries.
Now
I'm
that's
not the
very
chief financial markets guy.
sophisticated.
It's complicated.
Yeah, I was gonna say that was a very sophisticated answer.
I just
Um,
hope I'm remembering that correctly because I remember looking this up last year for the other loan assumption we did.
okay. So let's talk about the capital raise side of things. What was your total raise and how did you structure this for your investors?
So we ended up doing roughly, I want to say about $14.5 million on the raise, which was far and away the biggest equity raise we've done to date. It was close to double our largest equity raise prior to that. And we really divided it into a couple tiers, similar to what a lot of people do. We had a larger tier if you were, I want to say, a quarter million or higher, where we just gave a higher preferred return and a lower promote. And then for retail, which was below that $250,000 mark, it was, let's call it a 30 over an 8 and 40 over a 20 or something along those lines.
Okay. And then did you bring on, since this was double your normal raise or like your previous raise, did you bring on any additional partners or was it still just you?
So we had to bring on some additional guarantors who are they're very low profile, so I can't say who, but we had to bring on some additional guarantors and they definitely did more than their weight in helping with the equity raise. Really grateful to them on that part. I
Awesome.
mean, luckily we had 6 months to do it, so
You had a long runway. Yeah, with the loan assumption for sure. Well, as we wrap up here today, Will, what did you find that was easy during this process that you thought would be harder? And then flip it on its head. What ended up being harder that quite honestly you thought would be easier?
uh, well, I thought the loan assumption process would be easier the second time around. Um, we had obviously gone through, and it was actually a very similar situation. We were buying a property. Berkadia was the broker. It was a Fannie Mae loan assumption, and Berkadia was the servicer handling the loan assumption. We hit a few snags when we did it last year, but I was feeling really confident that, now that we've done it once, it's going to be smooth sailing. It was not quite smooth sailing as we had hoped. About 3 weeks before our first scheduled closing, there was a problem. We had to frantically fix it. We had to extend the contract by 30 days. So I was hoping that was going to be easier, not going to lie. Um, what was easy that we thought would be hard? I mean, I just feel like nothing is ever quite easy, especially in today's environment. I mean, any operator out there knows it's a tough environment to raise money. Investors are a lot more skeptical than they used to be. We're thrilled with how we're performing right now. We feel like we're raising more money than we ever have. We're buying bigger assets than we ever have, but it's still not easy to do. It's not 2020 when you just send out the email and you've got $30 million in 2 hours.
I hear you on that one. Well, thank you so much for your time here with us today. If the listeners want to reach out and learn more about you and connect with you, how can they do so?
The best way to connect with me is either on LinkedIn, Will Matheson on LinkedIn, or you can go to our website, www.mathcap.com. I'm laughing because I spelled the www, but mathcap.com, mathcap.com. You can schedule a call, join our newsletter, anything like that.
Awesome. Well, again, thank you for your expertise and sharing that with us here today. We look forward to hearing about your future deals.
Oh, thank you for having me.